In finance, as in life, there are a number of dichotomies that arise. For example, in finance, there's the concept of compound interest. Compound interest can be beneficial for you and for your finances if you purchase financial products, stocks, bonds, certificates of deposits, and other asset classes that yield to you a return rate. But compound interest can keep you stuck in poverty or the middle class if you're always consistently borrowing money or not paying back your credit and loans on time and consistently getting penalized. Now, similarly in finance, there's the concept of understanding what you invest in. Warren Buffett, Charlie Munger, they say that, and they maintain that you must understand the investment instrument that you're investing in before you invest in it. Otherwise, you risk participating in a bubble or getting scammed. Now, on the opposite end of that spectrum, there is analysis paralysis, where you study something to such a degree that you never take the appropriate action on it. Both of these are examples of financial dichotomies, and there's a number of those out there. Let's discuss. You know what to do. This is Derek West for Finance Squared. Like, subscribe, click the notification bell. Let's dive right in, right? Here are some examples of financial dichotomies. Risk versus reward. This is a big one, actually. Risk is key to getting any kind of wealth and growing your wealth in any major way whatsoever. The higher your risk, the higher your reward. So, for example, if you only save money in savings accounts or checking accounts, you're being safe with your money and you're being smart with your money to a certain degree. But your money is just going to sit there. And what's worse, your money's going to lose value. We all know in these times, thanks to everyone's favorite economic phenomenon, inflation. High inflation, as a matter of fact. That if you just put $200 in the bank, let's say 4 years ago, that same $200 buys you less goods today than it did 4 years ago. So the money that you have in the bank became worth less. So the risk that you realize by just leaving your money in that bank account is that your money became smaller and smaller and you had less purchasing power to use with that money. So you had a low risk saving and investing strategy, but that risk was realized. Because of that, your money became worth less, although you still have that money. It's just not able to give you the rewards that you're looking for from it. And on the opposite end of the spectrum are high risk investments, but those same investments could have high rewards. For example, if you had purchased crypto, Bitcoin is the most prominent example of mine, because that's the first crypto that I purchased way back when. There is a little bit of high risk there associated with purchasing crypto, right? If you just bought, let's say, $20 worth of Bitcoin back when it was worth less than $100, there really isn't a high risk there per se, because sure, no one knew back then what Bitcoin was and what it could turn into. So you just would have lost those $20 if Bitcoin fizzled out and nobody cared about it, right? However, Bitcoin is something that everybody cares about. That stated though, if you lost those $20, you lost 100% of your investment. So if you were really enthusiastic about Bitcoin, and this is in a bizarre world, by the way, to make sure you're understanding the context. If you were really into Bitcoin, crypto at the time, and in this bizarre world, this bizarro context, crypto fizzled out. Nobody cared about it. No one wanted to use it. In that instance, if you had purchased $100,000 worth of Bitcoin, like some people did way back in the day, who are also very enthused about it, in the real world, not in this alternate context, alternate universe kind of world, those individuals made a ton of money, became billionaires off of Bitcoin growing the way it did. But in the alternative universe, where Bitcoin fizzled out and crypto fizzled out, you would have lost 100% of your investment. So that is a high risk, high reward scenario. If you risk $100,000 on a very risky asset class, like crypto was back in the day, you have the possibility of losing all of your investment. And in some instances, losing more than your investment, right? Some investment strategies, like shorting, for example, they force the losses in that strategy are technically infinite. Now in the real world operations, they would never let that happen. You would sort of just get busted out eventually. And actually one of the downsides of shorting is that the rewards aren't actually that big. I should do a separate video on that so we're all in on that, so we all have a better understanding of that. But make sure you like and subscribe so you're there when it drops. There's another financial dichotomy. Liquidity versus return. Now, assets and asset classes that can be quickly converted to cash, i.e. savings accounts, typically offer lower returns. We talked about savings accounts, checking accounts, etc. earlier. And that literally is the most liquid thing, almost the most liquid thing that you can have. I am trying to think of another example of something very liquid. Maybe stuffing money under your mattress, where you just have cash like floating around under your mattress. That might be the most liquid thing you can do. But the next most liquid thing that you can do is just have your assets or your money in a bank account, savings or checking. Now you have a lot of access, in most cases, to money that's in a checking or savings account. As a matter of fact, those are the kinds of accounts that you had the most access to your money with, right? But as the liquidity of the asset class decreases, your access to your cash also decreases. But generally speaking, as the liquidity of the asset class decreases, the returns or potential returns of the asset class increases as well. So it's a financial dichotomy. So we talked about savings accounts and checking accounts, but then there are certificates of deposit, right? In certificates of deposit, you generally agree that you're going to put your money into this CD for a specific period of time. And If you take your money out before that period of time expires, then you pay a penalty of some kind. So your liquidity goes down, but your potential return goes up. Examples of less liquid asset classes. Real estate. You have to put your money into real estate for a long period of time. And to pull your money out, oftentimes borrow against that asset class or the equity that you have within that asset class. But if, for example, you get a mortgage to own a house, you're going to pay on that mortgage until you're done paying it off. And again, you can get that money out by borrowing against that mortgage or against the asset the mortgage is buying, as a matter of fact. You're not really pulling that money out per se. It's still in there. The potential returns of owning a home are greater than putting your money into a bank, as a matter of fact. Now, this is not always true. For example, if you put your money into an S&P 500 ETF or index fund, you can actually move your money around relatively simply, relatively quickly in those asset classes. But those asset classes, they rise and they fall. And the best way to profit, to be profitable long term, especially with those asset classes, is leave your money in for a long period of time. Time under tension is what I like to call it. So while it is more liquid than other types of assets, the best way to profit off those types of asset classes is leave your money in there long term. So in a way, it is kind of illiquid in and of itself, but not in the strictest sense. But that kind of takes me to my next financial dichotomy, right? Short-term versus long-term investments. Short-term investments, they typically will offer you quick returns and can be beneficial in volatile markets. But again, they're riskier than long-term investments. Like I talked about earlier, the riskier the investment, typically the greater the return that you can have. But then there are long-term investments. They tend to be more stable and can weather market fluctuations, but they require patience. Now, I just talked about putting your money in an S&P 500 index fund, right? That's more of a long-term investment strategy. That is, if you think you have like a 30, 40, 50-year investment horizon where you can drop cash into an asset class, where would you drop it into? An S&P 500 index fund, broad-based index fund. That's probably where it should go. Keep in mind, we don't offer advice of any kind in investing on this channel. But generally speaking, the knowledge and the best practice is if you have a long-term and a big investment horizon, 20, 30, 40, 50 years, S&P 500 index funds, that's the way to go. Now, they're going to be more stable, but they're not going to be you're not going to be making 200%, 300%, 600% on your investment, particularly in the short term. And that's just the dichotomy that exists for you. Investing in single stocks, investing in crypto, like I talked about earlier, investing in real estate, as a matter of fact, and other asset classes like that. They offer the opportunity for shorter term gains, maybe not real estate, but shorter term gains also being more risky. Another financial dichotomy. And that takes us to the next financial dichotomy, diversification versus concentration. An S&P 500 index fund is a very diverse investment vehicle. Right, you're spreading your investments across different asset classes or really different companies within the same sort of asset class, stocks. And that reduces the risks of you losing all of your money in one single stock, but also might dilute your returns should any one of those single stocks break out. And the opposite of that is concentration. That means focusing your investments in a few areas, and those few areas can lead to higher returns. But there is the possibility that those areas could go bust entirely or could lose their value significantly. If you wanted to invest in Blockbuster Video in, let's say, 2003, that's a very concentrated investment. And in 2003, nobody knew what was going to happen. And if the folks at Blockbuster Video had invested in Netflix as an example, they could still be around and still be kicking and making a ton of money. They didn't, and they missed out, and there's like one Blockbuster Video left in the entire United States and in the entire world, as a matter of fact. There's also the example of Amazon. Amazon was kicking around in 2002, 2003, just really starting to get their growth curve going. But even following that, like 2013, 2014 timeframe, I knew people that refused to invest in Amazon because they were never profitable. And they were convinced that Amazon and their competitors, or competitors of Amazon, were going to come through and come along and take their market share. So far, as far as delivering products to end customers, no one's been able to chip away significantly to Amazon's market share. And the same thing for their cloud services. They're the king of the hill for now. If you'd concentrated all of your resources, or a lot of your resources, into that investment way back when, you could have made a lot of money. That's just another dichotomy between diversification and concentration. If you have S&P 500, if you have Amazon as part of your portfolio, a broad-based portfolio of companies that you're invested in over the long term, you're probably still making money. As an example, as part of your S&P 500 index fund, you're probably going to be making money. And if Amazon falls out, and Amazon, like Blockbuster, loses their market share, you're still going to be fine because it's just going to be replaced by the next big company that comes along. That stated, you're not really going to grow at the rate that you could have grown if you had just invested in when it was brand new and starting its growth curve. Similarly, and all these things build upon each other, as I'm sure you know, There's growth versus value investing. Growth investing focuses on companies expected to grow quickly, and it can lead to higher returns, but also high volatility. The example of Amazon comes back into view, right? Same thing with Tesla, same thing with Nvidia. In a lot of those cases, sure, they're growing high now, but if you had been with them at the beginning, or are with them as their fluctuations in the market are happening, you'll know very well that the volatility with these types of stocks, growth stocks, can be extreme and a little nauseating to investors that, are a little bit queasy and have a hard time ignoring market fluctuations. Then there's value investing. That's investing in undervalued companies, and that can be more stable, but again, it could offer slower returns. Now, those returns can be large, but they're going to come in slowly. And then there is the case of active versus passive management as a financial dichotomy. Now, an active managed fund is a fund that aims to outperform the market. But because you're aiming to outperform the market, this fund will oftentimes have higher fees, and in most cases, may not always succeed. I forget the exact statistic, but I think Warren Buffett mentioned that somewhere between 80% to 85% of actively managed funds don't outperform the S&P 500. That's pretty bad. But if you're in one of those funds where it does outperform the S&P 500, you're going to be in a position to make greater gains than you would otherwise. But then there's the passively managed fund, right? Passively managed funds, they typically have lower fees, and they just track the market, but they don't aim to outperform it. So generally speaking, you're going to do as well as the market does. And it could be good, it could be bad. In the case of the S&P 500 index, over the course of, I forget exactly how long it's been, but generally speaking, it over the last 50 years or so, let's say, returned anywhere between 8 to 13% annually, year on year. So if you just follow that, you should be good to go. And those are just a couple of examples of financial dichotomies that one can expect to experience when looking through and navigating the financial world. Sort of like how dichotomies exist also in normal life, in regular life, and your everyday experiences. Those are just some thoughts of mine on financial dichotomies. So let me know in the comments down below what you're thinking about with financial dichotomies. Which side of those dichotomies do you play the most? Are you more of a risk taker, or are you more of a play it safe kind of person? Both strategies and both sides of that dichotomous coin are legitimate ways to grow your finances, to grow your wealth. Let everybody know what you're thinking, and take to heart that a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'll catch you guys in the next video. Gotta get out of here. Running late. Like, subscribe, click the notification bell. Check out one of the videos you see on the screen, and I'll catch you in the next one. Peace.